Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 23rd day of January 2015, and this is the Gold Forecasts Weekend Review. And what a week we have seen in this market all over the board. A tremendous upside surge in gold and silver, although we are ending a little bit south or down on the day, definitely up on the week. First to gold, currently trading at $12.9340, puts it off roughly $8 to $9 on the day. It has had a low of $74.90 and a high of $13.0210. Silver also trading lower on the day, but tremendously higher on the week. In terms of the net change on the day, very, very little. We're looking at $18.29. It puts it off roughly 1 cent on the day. The low $18.11, the high $18.33. More on silver towards the end of the show. On today's weekend review, I want to cover two very important topics. The first topic that I do want to talk about is our current strategy for our current trade, our exit strategy, where we're looking for gold to possibly go to next week, and how to maximize returns on our long gold and long silver. The second topic that I want to discuss is really more of our long-term view on the market and the potential that what we've witnessed as we've seen this market break out and really trade off of these lows back in November is really a potential for a key reversal. And at this point, a case can be made for the bullish model that we kind of pushed to the side as the market was moving down, and that is what's called a bear market truncation or a truncated fifth wave. And I want to bring that back into the limelight because with these most recent moves, that model truly is something that could hold some serious weight for the future of gold pricing and silver pricing, because they tend to move in tandem over the next 3, 6, even 9 months. So let's first cover our current trade. We are long gold. We got long at roughly 12.17.5. It was really this spike up here that we entered when it broke above the long-standing resistance line that we had in there. Of course, it's not in this particular chart. We did enter the trade, got in roughly at 12.17.5. Now, the market did come down. We had our stop initially below $1,200, and you can see how that how that stop absolutely held. And then the market really began to track or trade higher. We moved our stop. I believe the first move was just under 25. Then we moved it to under 57. Currently, our stop is tracking at 74. 1274, that's going to be somewhere roughly in this area right here in which we have a stop. So we are long at 1217.50. We have a stop at 1274. Now the market has actually come up and hit our numbers. If you recall, and you can go back and review when we put the trade on, but our original strategy in terms of an exit target to where we thought gold could go to was between 13 and 13.12. We certainly took those numbers out when we went above 13, intraday high of 13.08. So therefore, my question is, have we seen the first part of this rally? In other words, at some point it's going to correct. We're going to go into our wave count, and that's really what I want to talk about in the second part of the show, where I discuss the longer term objectives or strategies that we could be looking at by looking at a model that we haven't visited in a while. But the real question short term right now is, have we seen a potential top right in gold, and are we going to see a little bit of profit taking come into the market? If that does happen, we are positioned in such a way that if the market comes down, it would, of course, stop us out roughly at 73, 72. I told you to put it below. And we would pull our profits. Of course, our profits would be in between this particular mark here of where we pulled profits. If it continues to go higher, of course, we'll continue to trail stops up. But my sense is that we really have achieved what we set out to achieve on this trade, and now we'll have to see how the market wants to unwind this trade. Because my sense is that as long as it's going to maintain an upward move and we're long the market, we want to stay on this ride as long as possible, but we also want to exit during the earliest signs of a ruffling of feathers, so to speak. In other words, a point in which we'll see this market start to correct. And so the second topic that I really want to cover in today's review is the possibility, the potential that what we have witnessed now that we've seen this dynamic move to the upside in gold, again, now we're looking at a much longer term chart, is whether or not we have finally concluded our fourth wave down, this tremendous sell-off in which we saw the market go from 1900 down to 1130. And if we look at one of the models, I know you've seen this model before, where we have a major first, this being our major second, this being our major third to our record top, our major fourth. If in fact that is true, and we have witnessed some sort of a bottom, and of course, as we talked about, it does match up, of course, with a retracement level that is truly valid for this type of correction after the types of moves that we have witnessed in the market. But when we look at it from this point, it is possible that what we're really looking at is a bear market truncation. Now, on a bear market truncation, you're obviously, here's wave 1, wave 2, wave 3, wave 4. Now, wave 5, the thing about a bear market truncation is in a normal Elliott wave count, your fifth wave is going to go well below that of wave 3. And those were the bearish models that we were looking at towards the end of the year as this market was under pressure before it broke above that resistance line, that we would have really a standard fifth wave, which would make a lower low. Now, we made a lower low, but not by much, 1130. And so on a bear market truncation, the key to that is that your third wave and fifth wave are pretty much equal. And when we remove all of the lines that I've put on there so we can see the lows, when we look at this big picture, of course, you do have a lower low, there's no doubt. But they are, in terms of a big picture, relatively close or flat. And so a case can be made for the fact that what we're looking at right now is a bear market truncation. Now, here's the thing. If, in fact, we've seeing a bear market truncation, and that truncation has really shown us that we are now in a major fifth. Well, a major fifth is going to take us to new highs. Now, it's going to take us to new highs over a period of 2 to 3 years. We're not talking about something that's going to happen overnight. But what that means is that we might have weathered the extreme lows as this market sold off, and the extreme pressure that has been put on gold prices over the last couple of years here, 13, of course, 14, and of course this all began really 2012 when the market hit the second of two tops at 1800, and it's really just dramatically sold off ever since that point. And so there is a case to be made for this type of a model now that we have seen the market solidly break above this long-standing resistance line. We couldn't make any kind of a case for a bullish model as long as we were trading below this resistance line. The fact that we have moved back up is substantial, and it brings into light the real possibility that what we're now witnessing is the conclusion of that corrective period that we've seen over the last few years, and we are going to go into a bullish phase in gold. It is utterly exciting, to say the least. We'll have to see how it plays out, but this is the first real indication over these last couple of weeks that what we are looking at is that pivotal key reversal in gold. So what I want to really focus on next week is really to expand our reports looking at this type of a model, and then creating our sub-model behind it for what we're looking at in terms of actual waves themselves, our wave count, and realize we're probably in one of one right now, and that's going to, take 1, 2, 3, 4, and 5 waves up. But it does appear as though we could certainly be at the beginning of a real bullish rally, and we will explore this model as well as a couple other bullish models in detail next week. So traders, what about silver? Well, our stop is currently at 1762. We've got tremendous profits. I believe we're in at around 1650. And just like gold, silver has hit our numbers too. The basic strategy that we had, and you can obviously go back and listen to the videos that we produced when we came out with this trade, but this was the point, the mark that we were looking at silver to go to before I felt it would find some real resistance. I believe I said between 18 and 1850. We have certainly hit these marks. For it to really break through here, it has substantial technical resistance in this area. So my sense is that we'll be pulling profits probably early next week in both gold and silver, and pulling profits no matter where is always a good thing. This has been Gary Wagner, wishing you as always good trading. We certainly got that again this week. Have a great weekend. Talk to you on Monday for another daily update and review. Bye-bye.